Hey guys, welcome to the channel Market Uncharted. In today's video we are going to talk about the difference between ETFs and ETNs and what you need to know. An ETF investor owns the underlying investment, while an ETN investor owns a debt instrument issued by a bank. Specifically, ETN investors own a bond backed by the credit worthiness of the issuing institution. While ETF and ETN share many similarities, both have structural differences that are materially important for an investor to understand. Ownership structure, share creation redemption process, tax treatment, investor counterparty risk. ETNs are like zero coupon bonds and pay no interest or dividends during their lifetime. Because an ETN does not pay dividends or interest income, there is no tax due. Hence, they have preferential tax treatment when compared to ETF. ETN investors only pay capital gains taxes when they sell the security. Although ETN promises to pay at maturity the full value of the index minus the management fee, like any other debt security, the investment is subject to the credit risk of the bank issuer. If the issuing bank does not have the capacity to pay the investors when they want to redeem, the investors do not get their money back. For example, if the bank that issued the ETN were to go bankrupt, the investor would risk a total default on the ETN. To get any money back, they would have to wait in line with the bank's other creditors in the bankruptcy process. ETNs have an advantage over ETFs in terms of tracking errors. Tracking error is technically eliminated in ETN as the issuer agrees to pay the full value of the index less the expenses once the fund matures based on the price of the asset or index. In summary, ETNs may have advantage over ETFs in taxation and minimizing tracking errors, but ETNs may have disadvantage when compared to ETFs in terms of credit risk and liquidity. You can see here in the chart exactly this. I advise you to stop the video and take a look more closely. And just another comparison between ETFs and ETNs: funds versus structured senior debt notes, hold the underlying asset versus do not hold, track underlying assets versus the track itself, trade like a stock, both, slippage in ETFs with no slippage in ETNs, and ETFs are more liquid. So thank you guys so much for watching this video. Never forget, knowledge is not power, knowledge is potential power, execution is everything. And just like the markets, we will not rest.